Hi, and welcome to HCM's Q1 market update. My name is Doug Johnson. I'm the senior investment strategist here at HCM. We just want to give a quick reminder that you have clicked on the longer version of this presentation. We do have a shorter kind of executive summary version available on the website as well. But if this is the one you intended to click on, we're glad you're joining us today. And we hope that the information that you'll find is valuable and useful. So with that said, let's go ahead and get started. So as I mentioned earlier, the first two slides are more of an executive summary, and I'll go through those fairly quickly so we can spend a bulk of our time on the charts. But for us, equities remain at a neutral target. We've had a slight reduction in our defensive positioning. That was a trade that was done at the beginning of 2020, where we took half of our U.S. min vol position and moved it, a majority of it, over to the international side, with some remaining in the U.S. We did this because we believe that the commitment to lower rates by the Fed should continue to support equity prices going forward. We've also seen cyclical sectors replace defensives as the strongest performers into the end of the year, and that's usually a sign that overall confidence is increasing. The phase one tariff deal, along with a weakening dollar, has kind of set the stage for the potential of outperformance for international assets. We haven't taken our international underweight to overweight. We haven't even taken it up to neutral yet. But we have moved some money to the international side as we believe conditions for the potential for outperformance are starting to pop up. On the fixed income side, our duration remains slightly below benchmark levels. And as a reminder, duration just describes the relationship between interest rate movements and price movements. So since we believe that that rates are going to most likely stay range bound, we've made the decision to remain slightly below the benchmark, with the possibility that you could see inflation pick up, you could see growth pick up, rates moving higher would affect holders of duration more severely, I guess, than what you would see in some shorter duration bonds. So we're just slightly below benchmark, but we're confident that that's a good place to be for now. Confidence in the return of stronger economic growth, it could drive rates higher, providing a headwind for fixed income returns versus 2019. But as a reminder, 2019 was a really, really good year for fixed income with the benchmark levels returning their highest percentage in the past 17 years. Spread sectors such as high yield, emerging markets, and credit could outperform if rates were to move higher. But again, we think that those are still expensive assets. So we're not eager to overweight those necessarily. We do own them. But versus historical norms, they're still very, very pricey. And as I mentioned earlier, the base case for rates, in our view, is for them to stay range bound. If I had to put an actual number on it, the 10-year Treasury would probably stay between 2% and 1.5%. On the economic front, we think growth forecasts have improved slightly, mainly aided by the phase one tariff agreement. Recession concerns in the U.S. still remain, though as the Fed is committed to providing liquidity to the market and keeping rates low, we think that the chances of recession have certainly diminished. Inflation pretty much remains put right at 2% or a little bit below that. And then as the presidential election comes into focus, we think that the political issues will begin to heat up. But we're still a ways away from the actual election. The assumption is that Trump is going to win the Republican nomination, and we're still trying to sort out who the Democratic candidate will be. So risks going forward, we would say there's several. The first would be that slowing economic growth would eventually accelerate into a recession. Growth right now is kind of in a Goldilocks state. It's not too hot to drive inflation, but it's not too low to bring in a significant fear of recession quite yet. But if that slowdown increased, recession risk could be back on the table. If we saw any kind of rollback of the phase one tariff deal, now the deal has been signed, but that doesn't remove the possibility that we could see some sort of regressive action down the line. But for now, that seems unlikely. If we were to get any unexpected message from the Federal Reserve in the direction of future policy, so most people expect for the Fed to be, I don't want to say non-existent, but to take no action this year. No hikes, no cuts, just to kind of stay in the background, so to speak. So I think if you got a message of the possibility for rate hikes, I'm not sure that the market would like that. On the flip side, if you got a cut that was accompanied with severe economic slowdowns, that as well might be a little too late. But anything that would be a shock in terms of policy, I think could upset the market a little bit. Geopolitical tensions, specifically with Iran, the situation kind of came and went. I think a lot more quickly than most people expected, and things have seemed to die down. But if there was any escalation there, I think that the market would take a look at that, and you'd certainly have things like oil reacting significantly, which could eventually trickle over into the equity markets. But for the time being, we're hopeful that kind of came and went fairly quickly. And lastly, if we saw an unexpected increase in inflation, that certainly I think would catch a lot of investors off guard, and would cause a pretty swift repricing of assets, both on the fixed income and on the stock side. So the first chart that we want to show today is from Ned Davis Research, and what they did was they track 8 different asset classes that range from U.S. equities to international equities to bonds, commodities, and real estate. And if you look at the top panel on this chart, you'll see green vertical bars with little blue boxes. So those green bars represent how many of the asset classes that they polled in a specific year that had a return over 5%. And what you'll notice is that in 2019, 100% of those asset classes, or all 8 of them, had a return above 5%. So, looking at what worked in 2019, I think you can definitely draw the conclusion that basically everything worked. Now contrast that to the year before, and you see that there is no green bar, just that blue dot, because it denotes that there were no asset classes that had a return over 5% in 2018. And in fact, if you go down to the lower pane, what you'll see in those 2 years is that 2018, no asset classes had a positive return. On the flip side, 2019, that little gray vertical bar with the blue box on the top, the red box on the bottom, and the green diamond in the middle shows that not only were all of the asset class returns in 2019 greater than 5%, the lowest one was 8.72%. So a significant year in terms of returns for asset classes, both equities, fixed income, commodities, and real estate. So very, very good year for investor portfolios. Now, why is that? Well, I think that if we go back to the setup for this rally, you've got to go back to the end of 2018, the beginning of 2019 to see how this all played out. So in October of 2018, you had many investment houses on Wall Street calling for an additional 3 to 4 rate hikes out of the Federal Reserve. which it sounds silly to say that now, but that was certainly the expectation for a lot of strategists. You you had the 10-year Treasury at right around 3.25, and that kind of started to put the brakes on the market a little bit. We saw a really swift sell-off, the worst December since 1928, followed by one of the best Januaries, I think, since '82. And you've got this massive V-shaped recovery, but the impetus from that was from the Federal Reserve going from a belief that they were going to raise rates 3 to 4 times, pivoting to a pause for hikes, and then switching to the idea that they could cut rates. And they actually cut rates 3 times in 2019. But more importantly, they also began adding assets to their balance sheet, which has historically been known as quantitative easing, though they made a point in every presentation and press release to call it not QE, which is silly because that's exactly what they're doing. And you can see this chart here. This shows the total asset base for the Federal Reserve's balance sheet. And going back all the way to 2010, at the beginning of that chart, you can see the beginning of QE1, QE2, Operation Twist, basically everything that was done to pull us out of the great financial crisis. And then right around 2015, they stopped adding. Fast forward to what you'll see then right around 2018-ish, and they actually started to reduce the balance sheet. You can see that line start to move lower, 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 and then just recently they've said, okay, we are going to start to expand the balance sheet again. So that expansion is well underway. We're still not at the level that we were at the peak in 2015, but at this rate, we may be there sooner rather than later. The important thing is, as that flow of money is going into assets, and as those assets are coming onto the balance sheet, it's creating liquidity, and it's creating an environment where people feel comfortable taking risk and investing in things like equities, high yield bonds, credit, and it's been a massive tailwind for the equity markets. So there's a lot going on in this chart. I wouldn't necessarily focus on the details as much as just looking at the boxes and the corresponding numbers and seeing that even though we've come to a phase 1 tariff deal, we're still nowhere near to the levels we were back in January of 2018 before all this started. So just as a quick reference, if you go to the bottom left of this box, you'll see an 8% number in red and then a 3.1% in the blue box. And that just denotes the tariff rates. The red for China's tariffs on U.S. exports, and then vice versa for the blue. And even after this deal has been reached now, we've gone from 8 on China's tariffs up to close to 21. And then U.S. tariffs on Chinese exports, we've gone from 3 all the way up to close to 21 now, with the expectation that it'll go down close to 19. So making progress, and this has been important, and I think everybody is glad that we've reached some type of agreement that's taken the quote-unquote worst-case scenario off the table, but we've still got a long way to go before we get back to the levels that we were previously. So again, this we see this as a positive, and part of this phase 1 deal has allowed us to adjust some of our positioning a little bit. But again, there's still a lot that can be done, and we're hopeful that it does get done here over the next year or so. One thing that we're concerned about, though, is that we still see a disconnect between what we would call economic indicators and stock prices. So the blue line in this chart denotes the S&P 500. The red line is the ISM manufacturing purchasers managers index. And it's basically just a gauge on the health of the manufacturing community in the U.S. So what we've seen is that over the past, we call it 2 years, that red line has been slowly, or I shouldn't say slowly, it's been quickly moving downward, and has now crossed over the 50 level, which has historically been kind of the line in the sand for expansion and contraction. And we've actually spent a few months below the 50 line. So when we talk about being concerned about the economy, if you were creating a ledger with data points that would be recessionary versus data points that would not be recessionary, this one would certainly fall in the recessionary camp. And what you can see is that as this has been moving down, equity prices have been moving straight up. So these don't necessarily have to trade on top of each other, but if you follow the chart all the way back to 2000 with those vertical gray bars denoting recessionary periods, you can see that there's a pretty strong relationship historically between these two things. So we think in the short term, this disconnect can certainly continue, but over the longer term full market cycle, those will probably have to sync up again at some point, either being the result of manufacturing picking up or stock prices moving down, or a little bit of both. So certainly something to keep an eye on going forward. We've gotten a lot of questions about the election itself, but not as many about what stocks do in different years of the election cycle. So the fourth year has usually been pretty good on the whole, with an average return of a little less than 6. When we take all three, the third year is historically the best, and that certainly held true in 2019. But as the one thing that we've noticed is that during Trump's presidency, there's been a significant deviation away from the average, so to speak. So just going through, you have the first year almost at 20%, which is about close to 15% above average. You have the second year almost 10% below average. The third year now close to 16% above average. So what exactly is the fourth year going to hold? I think remains to be seen. Throughout Trump's presidency, he's been very pro-market. So we would expect that if he is polling well versus whoever the Democratic candidate is, it would more than likely result in being a positive for the market. I don't know that it's necessarily going to be the catalyst that's going to drive another 30% equity return, but it certainly shouldn't be something that the market would dislike. But as we get closer to November 2020, we think that the political landscape will begin to come into focus in the market. And we certainly think that once the Democratic candidate has been chosen, and if they happen to be polling strongly against whoever the Republican candidate is, we think that the market may take notice of that, and it could provide some headwinds simply based on the policies and the taxes that we've heard come out of the Democratic side. Now, that's not to say that we as a firm are for or against any candidate. We're simply making an objective observation. So one of the things that I think has certainly helped propel this market going forward, and if rates can continue to stay low, something that certainly could continue is corporate buybacks. So in 2019, we saw companies buying back a record number of shares, and you can see that it was by a decent amount. We hadn't seen anything like this since the middle of 2007. So when we look at ways that companies can return capital to shareholders, there's really two options: either through paying dividends, which is basically a cash payment to the investor, or they can use the money that they may have used to pay dividends to actually go in and buy back stock in the open market. They can also choose to do both of those things, which many companies will do. But what we've seen is a record year for stock buybacks, and as long as the ability to finance these purchases by borrowing very cheaply in the bond market, we don't see any reason why this shouldn't continue going forward. So the last slide that we want to go over talks about economic expansion. So if we go back to 1945 to today, what we'll see is we are now in the longest economic expansion, denoted by the number of months, since then. And we're about half a year now through that at 126 months. The other thing you'll notice is that although this is the longest, it's also been the weakest in terms of growth. Now, many will argue that those two things could go hand in hand, that you know, realistically with an economy this size, it would be next to impossible to have a 10-year expansion with a with a significant growth rate. It would just be too much growth for too long a time frame and would eventually cause significant imbalances that would right themselves. So in order for this expansion to have lasted as long as it has, you basically need growth that is, we'll call it mediocre. Not too crazy to kick inflation too high, but not too low to pull us into a deflationary cycle. So it's also been the first calendar decade since I believe the 1800s where we haven't had an economic recession. So the likelihood of us going through another decade without a recession is very, very low. So what we've told clients is that, we're not saying a recession's coming this year, next year, or anytime before that. But you're probably going to see one here in the next 5 to 10 years. And how we think about that and how we prepare for it is important. And we've reached out to clients before and during meetings and made it known that we do have a plan in place, an actual plan to adjust portfolio positioning to hopefully mitigate some of the downside that we would normally see in a recession. But for the time being, we're going to continue to ride this horse a little bit further, and we're hopeful that this expansion can continue. And we think that growth could tick up slightly, not only in the U.S. but globally, if rates remain low, if central banks remain accommodative, and the overhang of tariffs is slowly removed. So where does that leave us? We've told clients that we've been focusing on three main themes here for probably the past 6 months, and we've added two themes to that just recently. So the three themes that we continue to focus on are China, economic growth, and the Fed. And then the two that we've added since then have been, what's going to happen in the election, and then you have the situation in the Middle East in the background. So we believe all those themes are connected and are likely going to dictate what returns are going to be going forward. We think that the phase one agreement and an accommodative Fed are the two major changes that we've seen in those themes, and they've helped to take some fear out of the market. And it's kind of opened the door, so to speak, for risk assets to continue to run higher. And for us, it's allowed us to kind of tweak our positioning and slowly remove some of the more defensive positioning that we've had in our equity portfolios. So as a reminder, our positions remain at neutral, but we've begun to change the compensation of our equity holdings by adding some more money to things like international, looking at opportunities to maybe add some more cyclical sectors here. But it's still a challenge because when we look around the landscape, things are still very, very expensive. And valuations are probably still the main concern that we have and would most likely prevent us from taking any kind of overweight equity position. We just think that the starting point is too high, and there's just not enough there from a return side to take on that level of risk. But we have made changes in terms of rebalancing policies where we've maybe let our rebalancing bands get a little bit wider than what we normally would, and kind of let those movements run a little bit. So that's what we're seeing in the market for Q1. We want to thank you for joining us. We hope you found some value in this. And as always, if you have any questions, comments, concerns, please don't hesitate to reach out to your advisor, and we will be more than happy to make sure that those are addressed in a timely manner.